What is a down payment? How does that affect your loan amount? And how do those two things work together for your monthly payment? This should help. Simply put, your down payment is your initial investment when you're buying the house. You'll buy a house for a certain purchase price, you'll have your down payment, and the rest of it is going to be financed with your mortgage. I don't want you to worry too much right now about the different loan programs I have on the screen: conventional, FHA, USDA, and VA. I just want you to understand that each of these different loan programs have minimum down payment requirements, and that's what these are here. So conventional loans, if you're a first-time home buyer, you can typically use a 3% down payment. If you're not a first-time home buyer, then it's typically going to be 5%. FHA loans are going to start off at 3.5%, and USDA loans and VA loans are both 0% down payment programs. USDA loans are for rural areas, and VA loans are for our veterans. Some examples of these minimum down payments are right here. I used a $400,000 house. A conventional loan, if you're a first-time home buyer using that 3% down payment program, then that down payment is going to be 12%, meaning your loan amount is $388,000. So purchase price minus down payment equals loan amount. FHA loans, the 3.5%, that's going to be $14,000 for the down payment, leaving your loan amount at $386,000. And again, USDA and VA loans, if you're not putting a down payment, your loan amount is going to be the purchase price, right around $400,000. What's important to understand here is that your monthly payment is based on your loan amount. So if you have a higher down payment, your loan amount is smaller, which means you have a lower monthly payment. Some examples here: if you bought a $400,000 house with a 5% down payment, your loan amount is going to be $380,000. If you saved up for 20% down, then that $80,000 down payment means that your loan amount is $320,000. Something I want you to keep in mind is that you're not stuck with a certain down payment percentage. If you have the money for a higher down payment, you can put as much down payment as you can afford. Say you owned a house previously and you have $100,000 from selling that. You can put that $100,000 as your down payment and your loan amount would be $300,000. What goes into your monthly payment? We typically look at 4 different areas: principal, interest, taxes, and insurance, or PITI. You might also see PITIA, with the A being association dues or your fees for having an HOA. Your principal payment is what goes towards paying down your loan amount. So you have your initial loan amount, and each monthly mortgage payment pays down that loan amount. Interest is the payment that's going towards the lender. So that's based off your interest rate, and essentially it's the cost of borrowing money for buying a house is paying that interest back to the lender. Taxes refer to your property taxes. Those property taxes can be decided by the county or maybe your city, and they go towards things like teachers' salaries and road work and other infrastructure things. We're going to look at a couple different kinds of insurance. So the first being homeowners insurance. One of the easiest ways to think about this is like car insurance. So if you have car insurance and you get into a car accident, then that car insurance is going to pay you for damages to your car. Homeowners insurance works the same way. Say there's a fire or a flood, that's what the homeowners insurance covers you for. Mortgage insurance is a little bit different. If you're putting less than 20% down payment, then you typically are going to have mortgage insurance for your loan. This insurance goes to the lender because less than 20% down is a little bit more risky of a loan in their eyes. So this is essentially going to them to allow you to get into a house before saving that 20% down payment. In a different video, we look at the pros and cons of saving up to 20% down and not having mortgage insurance. But for right now, just understand that having mortgage insurance allows you to get into a home sooner. And finally, those HOA dues. Not every home is within an HOA. If you live in a condo, you probably have an HOA. But if you are in a homeowners association, there's going to be some sort of fee associated with that. So with all these things together, we have an example of what a monthly payment would look like. I used a $400,000 house with a 10% down payment, meaning a loan amount of $360,000. An example interest rate right now would be about 6.5%. I have a different video explaining APR, so feel free to check that out. So we look first at this principal and interest payment. The principal, again, is paying down your loan amount. The interest goes to the lender. $360,000 at 6.5%. You're going to be at $2,275 a month. Property taxes vary by state. So I used $120 a month. However, if you live in Texas or California, those states have higher property taxes. Expect your property taxes to be a little bit higher. Homeowners insurance works the same kind of way. If you're in a state with more natural disasters, say the hurricanes in Florida, and you live on the beach, then you're probably going to have some higher homeowners insurance to cover for that. For mortgage insurance, conventional loans base your mortgage insurance payment based on your credit score and how much of a down payment you've put down. So for this example, I used $80 a month. Something to keep in mind is that if you're doing an FHA loan, your mortgage insurance is based solely on loan amount, not based on your credit score at all. And finally, HOA dues. Again, not every house has one. Just to show an example here, I used $50 a month. With all those things together, we have an example monthly mortgage payment of $2,675 a month. I hope this helped explain your down payment, your loan amount, and your monthly payments. Check out some of the other videos, and I'll see you in the next one.